Okay, we're going to look at Chapter 12, Tax Planning Case number 2 on page 365. So, Agatha is planning to start a new business venture and must decide whether to operate as a sole proprietorship or to incorporate. She projects that the business will generate annual cash flow and taxable income of $100,000. Agatha's personal marginal tax rate, given her sources of income, is 35%. If Agatha operates the business as a sole proprietorship, calculate the annual after-tax cash flow available for reinvestment into the business venture. So I have laid out here our Schedule C income would be $100,000. Now, this is one thing that's kind of interesting because the book, if you go totally by the book, they're not including the self-employment tax, but in this case, it appears that it's her business and it's a sole proprietor, so you are going to have the after-tax income unless she has other income that offsets that part, which you would not probably imagine. So in this case, I'm going to use it. I'm going to take my self-employment tax of $100,000 income times 15.3%. So I'm going to have $15,300 of taxable self-employment tax. I'm able to deduct half of that from my adjusted gross income, so that's $7,650, gives me a taxable income of $92,350. At that point, my income tax at the 35% rate is going to be $92,350 times 32,000, or times 0.35 gives me 32,323 of income tax. My self-employment tax from our original calculation is 15,300. I sum that up, so I take my 92,350 minus my 32,323 minus my self-employment tax of 15,300. And I get my 7,650 self-employment tax, which was, or my half deduction on that, so I added that back into my income. So for my cash flow, I have 7,650 plus my 44,728, and I get 52,378 of after-tax cash flow. Okay, so now let's look at B. If Agatha operates the business as a regular corporation, C Corp, that makes no dividend distribution, calculate the annual after-tax cash flow available for investment. Well, in this case, that's pretty easy. We have $100,000 of taxable income from the corp. My tax is going to be $22,250. And my cash flow is $77,750. And again, I got that $22,250 from the corporate tax rate table in Appendix C on page 590, or the corporate tax table that you're using. If we look at C, now suppose Agatha wishes to withdraw $20,000 per year from the business and will reinvest any remaining after-tax earnings. What are the tax consequences to Agatha and the business as such a withdrawal, and the business operated as a sole proprietorship? How much after-tax cash flow will remain for the reinvestment? How much after-tax cash flow will Agatha have from the withdrawal? Well, as a sole proprietorship, there's no additional tax consequences for the $20,000 cash withdrawal. My after-tax cash flow, though, is going to be reduced by the $20,000, so I'm going to have $32,378 that will be available to invest into the business. Okay, so on D, what are the tax consequences to Agatha if the business, if $20,000 is withdrawn in the form of a dividend, if the business is operated as a C Corp? If how much after-tax cash flow will remain for reinvestment in the business? How much after-tax cash flow will Agatha retain from the dividend? Well, if I'm doing a C Corp, I start with $100,000. My tax again is $22,250 from the tables. My income after tax is $57,750. I'm going to have subtract my $20,000 dividend, so my cash flow for the business is $57,750. For me personally, I'm going to have a dividend of $20,000. I'm going to pay my taxable dividend of 15% times that $20,000, so that gives me a tax of $3,000 and gives me an after-tax cash flow for me personally of $17,000. And finally, if Agatha wishes to operate the business as a corporation but also wishes to receive cash flow from the business, what would you recommend to give her the best cash flow? Basically, she should consider organizing herself as an S corporation. It's entitled to a pass-through, eliminating that self-employment tax. She could also pay herself a salary, and any additional distributions would not be taxable, provided she has additional bases. So, again, that single level of taxation from the partnership pass-through versus the corporation, where you're basically being double taxed, is a key factor in calculating what structure you should pick.